Good afternoon, everyone. My name is Jeffrey Scott, and I am with New American Funding. I'm a loan officer of 18 years of experience. And we did the first class yesterday and covered a handful of topics. And one of the things for those of you that were here yesterday, I failed, and my sincere apologies, to click through the slideshow. It was honestly my first try at this, and I just got so nervous that I forgot to click through. So we have emailed you the slideshow, and I would encourage you to just go back and take a brief look at it, simply because it if it was told to me that you enjoyed or liked how I did the silos of the three different types of loans and how they're siloed themselves. Well, I've also done that with the loan process, and so it helps you see how many people are involved from start to finish and what needs to be required, or what it takes to actually close it. So with that said, one of the first questions that was asked yesterday that I promised to get back to one of the realtors was on the question was, what about temporary buy downs or permanent buy downs? And the idea or the thought process behind the buy down, I believe, was how, if my customer doesn't qualify at a 6.5% rate, when earlier this year he qualified at the 4 or at the 3.5% rate, can I get back to that 3.5% rate to get him qualified for the home? So the question was kind of a defensive maneuver against these rising interest rates that we've seen, and how can we combat that, or what's the solution? So I'm just going to pull on and go through this just super briefly. And then whichever realtors need more information on it, I'm glad to you email me, call me, text me, or text Cassie, and we can get together that way. But rates have jumped basically from 3.5% back in January to 6.5% today on a conforming loan. Not all customers' incomes have jumped. Therefore, their purchasing power has deteriorated or has weakened. They cannot afford the $600,000 house today. They can only afford the $450,000 house or the $475,000 house. And that goes across the board from the lower spectrum to the the $3 million home. Same problem. Rates go up, consumers' purchasing power drops, unless of course their income increases, but in most cases income won't increase enough in the last 6 months to bridge that gap. So we have two solutions to buy the interest rate down. One is a permanent buy down. The second one is a temporary buy down. The permanent buy down is where, if the interest rate is quoted at 6% and the customer wants to get to 5%, we can do a discount points where the customer could pay, and these are just round numbers just to give you an example, 1.25% in discount points to buy that rate from 6% down to 5%, to lower the principal and interest payment. Therefore, they can buy they can borrow more money to buy a more expensive home. In this particular case, I just threw out the numbers just so you could see it. On a $600,000 loan amount, if the customer was to buy it down 1.25 points, it's going to cost $7,500. Now, the $1 million question is, where's that $7,500 going to come from? Well, it could come from the borrower, but it can also come from the seller or the builder, or it could come from the lender. And so we call it down here a interested party contribution, and interested parties such as the lender or the seller or the builder can contribute to this $7,500 fee. And one way structure the transaction is if the listing price is at 500,000 and the selling price is at 500,000, you could actually increase the purchase price to say 510,000. And I round it up intentionally just because a $10,000 seller credit might be something that the seller would give back to the buyer at the close. So that's one way to absorb that fee. The temporary buy downs are temporary and they are not permanent. And these are generally always going to be paid by the seller at the end of the transaction, or the builder, or it could be done by the lender, but not always, because the lenders, when they contribute, it gets a little more expensive. But the way that program works, I've got 3 examples here. You could have a 2-1 buy down. So this simply means that for a fee, you can buy the rate from 6% down to 4%. In year 1, it dropped 2%. And in year 2, it dropped 5%, or it would drop 1% in year 2. So your effective rate would be 5%, and then at the end of year 3, it goes back to 6%. And this makes it more comfortable and easier to the consumer or the buyer to afford it as his income increases over time. But one of the caveats on this is that we're still going to qualify the customer at the higher 6% or the note rate. So it doesn't allow the customer to increase his purchasing power from a qualification standpoint, but it does ease the customer's monthly payments as he grows into it over 2 years in this case. There is a 1-1-1 buy down where it would actually years 1, 2, and 3, it would be at a straight 5% rate, and then it would in year 4 go back to 6%. And then there's just a very basic 1-0 buy down, so it just buys the rate down for 1 year. So if anyone has any questions about that or wants to get more detailed, we can get into that. The seller contributions are limited, so just keep that in the back of your mind. If the customer on a Fannie Mae loan is only putting down 10% down payment or a 10% investment in the home, then the max contribution is 3% from an interested party. If, however, they go over 10%, the max which is what we see an awful lot of, the max contribution from an interested party can go to as high as 6% of the purchase price or the appraised value. And then, of course, at 25% down payment or more, they'll actually allow 9%. It's a less risky transaction to the lender, and that's why they allow more. If it's an investment property, 2% is allowed. FHA is 6%, VA is 4%. So any questions on that, feel free to reach out at a later time and we'll cover that. But I did want to address it since it was a hot topic yesterday. Okay, getting into today's presentation. Oh, and feel free to ask questions along the way. Feel free to either put it in the question and answer section or the chat is fine. Elsie's going to help monitor that chat, and I'm open to helping in any way possible as we go along. The first portion of this particular presentation has to do with loan structure and how we structure a loan. And why this is important to you as a realtor is because the first thing that we need to know is what is the down payment that the customer is operating with, or what is the customer's capacity, reserves capacity that can be used for a down payment. The down payment of the house is the customer's equity investment in the home. Now, there is a distinction between if the customer says, I have $50,000 for my down payment, most customers don't recognize or realize that there are additional non-recurring closing costs and expenses associated with the transaction above and beyond the down payment. So if he says, I've got 50 grand, what I would encourage you to ask next is 50 grand, 100% of your pool of money to be used to buy the house? Or another way to ask it is, do you have an additional $15,000 on top of that for non-recurring closing costs, as well as prepaid taxes, prepaid interest, prepaid HOA fees, title, escrow, your non-recurring closing costs for the loan, et cetera, et cetera. And where customers get confused is they said, no, I told you I got 50 grand, when in fact they need 10 grand for all your non-recurring closing costs for 11 grand, and that subtracts from your 50 grand for your down payment. Does that make sense? Am I hitting that, driving that home? Because cash to close is not your down payment. They're two different items. Cash to close will always be greater than your down payment. So we need to determine down payment, but also a lot for the non-recurring closing costs. So once we've identified the down payment, then we can structure the loan, because we have lots of different structures. The most popular structure is a 20% down loan. And the reason that's the most popular structure is because there's no mortgage insurance or private mortgage insurance associated with it. The way the industry works is that and it's just kind of a standard thing that's occurred, 75, 80 years ago, or whenever this really started, mortgage lending, is if you put 20% down, then you're probably a fairly low risk to default on the loan, because you've got a 20% investment in the home, and therefore you don't need to insure your mortgage payments to me. I'll take that risk. But if the customer only has 3.5% down, then we have a product for them, and it's an FHA loan. And FHA will accept a 3.5% down payment, but it will have mortgage insurance, private mortgage insurance. And FHA actually has an upfront mortgage insurance and a monthly mortgage insurance, but FHA will go down to a 620 credit score. So some people kind of look at that as our subprime market, which we don't have anymore today, but it is a subprime. If A paper is A and C paper is, not prime paper, or it's subprime, then an FHA loan kind of fits that subprime market. If the guy's had delinquencies on his student loans, or delinquencies on his credit report for auto loans or medical bills or whatever, that can drive the FICO scores down. There is a conventional loan with only 3% down that does not have upfront mortgage, but the credit scores are higher, and it's going to be priced a little bit higher. So there's pros and cons to both of these two loans. That what we'll do with the customer is we'll walk them through it. You don't need to really be an expert at it. We'll walk them through it and explain which one would probably be better for them and why. And at the end of the day, we just present the facts and we let the customer choose. There is a 5% down loan that you could also do with an FHA. And the more you put down, the less your mortgage insurance is going to cost. I'll make just a quick distinction about mortgage insurance. On an FHA loan, it's permanent. until you refinance the loan. But on a conventional loan, if you take mortgage insurance, you can buy out of it over time. 78% is kind of the magic number of loan to value where they will end mortgage insurance for you, which is nice. So there's an advantage of that. You don't have to refinance it. It's not permanent on a conventional loan. 10% down is where your mortgage insurance gets a lot cheaper. And a trick that we use for mortgage insurance is that we've found that if there are two borrowers on the loan, your mortgage insurance drops. And the reason it drops is because there are two people supporting the loan, less risk. And so even if it's a housewife, a non-income earner as a second, or a house husband in today's world, that's a non-earner, that second person still drops the risk, because if they do get into a financial pickle, that person could theoretically go out and get a job. So that's a nice way to, or a helpful way to drop the insurance cost at the end of the day. And then there's also a structure where you put 10% down, you get an 80% first trust deed, and you get a 10% home equity line of credit, which is a second loan on top of the first loan. And that has no mortgage insurance whatsoever, but it is also tied to a floating interest rate. So there's risk there. So those are your loan structures. They are determined or derived from the customer's down payment. And the structure, now we're going to talk about the loan amounts and how that works. Fannie Mae, Freddie Mac are our two quasi-governmental agencies. They're called GSEs. And they want parity across America, from New York to LA, everybody be treated the same in between. And the mortgage, the conforming loan limit today is $647,200 across the board. And that's going to fit anybody that wants a home loan from Fannie Mae or Freddie Mac or Ginnie Mae. That's your conforming limit. Several years ago, they have developed a new bucket called the high balance conforming loan limit. And what that is intended for is that there are certain areas in the United States, such as New York City, San Francisco, LA, that are super high rent districts. And so they've allowed the conforming limit to rise to be as high as $970,000. So here in Orange County, LA, we're at 970. But if you look down to San Diego County, it's 879. Napa County is 897. Sacramento County is 875. Ventura is 851. So every county in California and really across the nation will have its own high balance loan amount that will fit the conforming guidelines of Fannie Mae or Freddie Mac. And then anything over these numbers are going to fall into what's called a jumbo loan. And of course, a jumbo loan is not Fannie Mae and Freddie Mac. Jumbo loans are, generally speaking, your major banking institutions like Chase, Citibank, Wells Fargo, Bank of America, the credit unions, etc. So when structuring a loan, we will also look at these numbers and we'll try to decide what's the best structure for the customer within these numbers. So sometimes we'll not really want to do a high balance loan because, generally speaking, they're a little bit more expensive than a normal conventional loan. And so we'll play with the numbers. We'll figure out a way to massage it and come up with a different angle to help the customer. So the next section is what's my interest rate? So this is a really fascinating subject, and why I'm bringing it up to you is because we have customers, we have realtors, we have my dad and mom call me up and say, well, what's today's rate? And it's not that easy. And so I thought I'd take a moment and explain to you why it's not that easy. I can't give you a rate, but if you put a gun to my head, I will give you a rate. But the rate I'm going to quote you, just like every other loan officer out there, I'm going to quote you on like a premier, super high credit, super low loan to value, one loan only, owner occupied, single family residence home. And I'll quote you that rate. So if you put a gun to my head, I will give you the lowest rate I can deliver you. But 9 out of 10 times, that's not really the question. That's not going to help you at the end of the day. And so I want you please to remember when someone says, what's my rate? To say, well, your rate is specifically reflective of your specific credit score, loan to value, property type, property use, and and combined loan to value if there's other loans involved. And let me explain to you how that works. In this particular scenario, I highlighted a 740 credit score on the left-hand side, below 60% loan to value. Let's see if I can move this over here. Give me 1 sec. Sorry. Oops. Should have done this earlier. Well, I can't seem to do it. So what I've done is I'm looking at the screen, and I know I'm not looking at you, but just bear with me. A 740 credit score, 60% loan to value has no additional fee or charge or loan level pricing adjustment attached to it. But how many people are at 60% loan to value? But if you put a gun to my head and you want to know my best rate, that's where I'm going. And it's also going to be a single family residence. It won't be a condo or 2 units, and it will also be owner occupied. It won't be a second home or an investment property. And let me explain why. So as we now specifically figure out what the customer's credit score is, 680 is average America. Scroll over here to an 80% loan to value, which is 20% loan down payment or 20% equity investment. Now, all of a sudden, I got 175 basis point fee to contend with. Now, that's not a fee that I'm going to charge the customer. Where that's going to come out is in the interest rate. And then if the customer's got a 640 credit score and he wants to do a 10% down deal or a 5% down deal, now all of a sudden I got 275 basis points of fees. And these aren't Jeff's fees, and these aren't NAF's fees, and these aren't Chase's fees or Bank of America's fees, or these are Fannie Mae and Freddie Mac, and they're non-negotiable fees. So they're going to collect that money inside an interest rate. And the way that 275 basis points is affected is in the interest rate. So instead of getting this cherry 740 FICO and under 60% loan to value, we now have to build in this fee into the rate for the customer. Now all of a sudden the customer is saying, well, that's not what you quoted me. And that is why it's so hard to quote a customer. Check out these other adjusters to rate. If it's an investment property at 75% loan to value, I got 2.125 or 208 in fees that have to be adjusted. A lot of investors might choose to pay this to get the lower interest rate, but that's a fee for an investment property. Check out this condominium one. If the customer is at 75% loan to value or less, or more, I mean, then I've got a 75 basis point hit. So on a condo, to get out of that, you really need 25% down. And that's just that, again, that's Fannie Mae, Freddie Mac. Check out the high balance. We've got a hit for that. What if it's a cash out loan on a refinance? Well, when a customer takes cash out of his house takes reduces his equity investment in the home by pulling cash out, it's considered a higher risk loan for the lender. Therefore, there's a fee. 3/8 is your standard fee if you're under 60% loan to value. But if I'm going all the way to 80% loan to value, I almost have a full point in fee that I have to adjust for. And then if I've got a terrible credit score, I got 175 basis points to adjust for. So my point is on pricing, it's dicey. And it's hard to just, my mom and dad call me up and say, well, what's the rates? Well, do you want me to say 4.5%? Or do you want me to do it right and find out what your credit score is, find out if you're trying to take cash out, do a refinance or a purchase, find out if it's a primary home, find out if it's a single family residence or a condo, and if it's a condo, are you under 75%? It's complex. So that's the game that's being played, and that's what I really wanted to just have you guys understand is, does that make sense? Are there any questions?
There are a couple questions in the chat. Are you able to see that, Jeffrey?
Oh, great. Let me try to locate the chat. Oh, here we go. Sorry. Okay, so let me just start at the top, scrolling down, questions and answers. Okay. I saw some questions going back to the seller buy downs. Email me and I'll address it, because there are actually reasons why the seller would do it or entertain it. Does locations or city play a role also? Not in the seller buy downs. No, it's open to all locations. With a home equity line of credit, a home equity line of credit is a second loan placed on top of the first loan, and it alleviates mortgage insurance in most cases, well, in all cases, really. It does make the first loan a little more expensive because the combined loan to value has increased. So it's a higher risk loan to the investor at the end of the day. Therefore, there's a risk adjuster to compensate for that higher risk. That kind of makes sense. What else?
In the Q&A, I didn't catch at what portion you were speaking about, but it just says meeting insurance is for the lender only and not the client, ? It protects the lender.
Okay, is there, oh, I'm getting more messages dropping in here. I'm sorry.
That's from Marla. Marla, if you want to restate your question in the Q&A or put it in the chat. Another one is, how do social media accounts like Keeping Current Matters get their interest rates at a glance?
Could you please reread that?
How do social media accounts like Keeping Current Matters get their interest rates at a glance?
Well, interest rates at a glance. For example, if you see it on social media or if you see it on the news and they say rates are 5%, generally speaking, what they're talking about is a 30-year fixed rate mortgage, and they're talking about and a lot of times there'll be a disclaimer somewhere that there is 1 point attached to it, because it seems like advertisers want to, well, people that are looking at rates or selling rates, for example, want to sell a lower rate to entice a consumer to call in. And so a lot of times, if you read the fine print or listen to the fine print on the radio, there's a 1 point attached to that. But all rates at the end of the day are risk-based priced upon the unique individual's scenario at the end of the day. That's just the way it is. So it's those loan level pricing adjusters that I was going through. An owner occupied, think of it this way, an owner occupied home versus a second or a vacation home versus an investment property are 3 different uses. If you got into financial trouble, you would probably let your investment property go first, probably. Then you'd probably protect your second home up in Big Bear or Mammoth or Palm Springs second. And then if you were in such financial straits that you let those 2 properties go, then you would probably protect the roof over your head with all your might in most cases. So that's the theory behind a less risky owner-occupied home. A single-family residence home actually has less risk than a condominium because a condominium is attached or in a group of other properties. So you've got a greater fire risk. You also have HOA issues and risk just in the nature of an HOA and multiple decision makers where you don't have that with a single family residence. And then of course there's rules and regulations. 2-unit property versus a 1-unit property has risks because the second unit is generally speaking rented. So you've got tenant risk and you've got risk of that income not coming in. 3 and 4 units is even a higher risk because now you've got 3 or 4 extra units where can be challenges in collecting the rents. So those are, at the end of the day, you know, if Facebook says the rate's 4.5%, I mean, I could say it's 4.5, but in all the sub numbers, contingent on these 30 characteristics and you paying 2 points to get that. So good question though. Okay, what's next?
I did get clarification on this one from Marla. So mortgage insurance. So she's asking, is mortgage insurance for the lender and not only the client?
Yes, mortgage insurance is to protect the lender in the event the customer stops making payments. So what would happen is that the mortgage insurance would kick in and make that payment to the lender to keep the loan current at the end of the day. It's not current with the customer, but the investor, it's current. And I like mortgage insurance a lot for a lot of reasons. There's nothing wrong with paying mortgage insurance. And think of it in this way. If I cannot save up, let's say I've saved up 50 grand for my first house. If I can't save another 50 grand to get to a 20% down payment to get me into the house, I can use the 50 grand I have saved up and pay mortgage insurance for a period of time to still buy the house. So I have rented that additional 50 grand for $160 a month. Now, isn't $160 a month cheap for a 50 grand equity infusion, though it's not really an equity infusion, it's a substitute? I say yes. It's tax deductible, it's not permanent, and my wife and I blow 160 grand on dinners every month. So we cut out those dinners and we now own a house. And that house, we can write off our taxes, we can write off our interest, we can write off our mortgage insurance. So I get all those benefits. So man, there is nothing wrong with mortgage insurance. What's next? just to make sure I'm understanding this correctly, say the interest rate is 6%. Based on this current slide, it would be an additional 1.75. So overly simplified, it would be 7.75. Is that correct? Okay. I have confused you. My apologies. A buy down is an upfront fee. And oh, I'm sorry. I believe this is pertaining, the 1.75, I believe is pertaining to a loan level adjustment. No, you would not add a loan level adjustment to the interest rate. A loan level adjuster is buried inside of the interest rate. Now, if the customer wanted to pay that 1.75 to get the 6% rate, he could. But actually he would get a less rate. You are not adding that 175 basis points is a fee and it's not an interest rate. Does that make sense? The fee is, it does get a little complicated. I'll take just one brief moment to try to explain it. Let's use a 6% interest rate plus 0 points. So that's called par. So if the customer qualifies for a 6% rate at par, that's his number. Now, inside that number could be several costs. Inside the 6% rate could be a FICO hit. It could be a property type hit. It could be a units hit. It could be a loan to value hit. It could be any of the different hits. If that customer had no hits, that rate, for example, could be 5.5%. If the customer wanted to pay all the fees out of cash and his rate was quoted at 6%, but he wanted to pay all those hits out of cash, he could and still obtain the 5.5% rate. Does that help? I will admit it gets very confusing.
Another question is, can client buy down to 0%? And how can the client know the loan officer provides the lowest rate?
Okay, good questions. No, you can't buy a rate to 0. The banks will allow these temporary buy downs or these buy downs up to a certain point, but they still want a return on their investment at the end of the day. It gets very expensive to buy the interest rate down in an upward rising market. The reason is that the market's predicting higher interest rates, so they don't want a 4.5% rate if the general rates are going to be 6.5%. But if you want to buy it down to 4.5%, you could, but it's going to cost you a lot, but it's definitely doable. But will they let you go to 3% or 2%? No, it would get cost prohibitive. That number would just inflate to a number where it doesn't make sense from a consumer standpoint. Now, in a declining interest rate market, your buy downs are cheaper. And the reason is if today's at 6.5 and we expect it to drop to 5, if the market believes that, then they'll say, okay, I'll let you buy it down to 5 because I think it's headed that way. And so it's a cheaper cost to buy it down. And then your follow-up trailing question was about how do you know if the loan officer is giving you the best interest rate? It's an excellent question. You will develop a relationship with a loan officer that you trust. I will admit, most loan officers will probably quote a rate lower than the rate they can deliver. But that's not uncommon because the consumer is out there shopping rates saying, I want a 4.5% rate. I saw that this company can give me a 4.5% rate, so I'm going to go with that company. But when they get into the transaction, the cost of that, or they don't fit that 4.5% quote because of credit score, loan to value, property type, property use, et cetera, et cetera, et cetera, then the loan officer's backpedaling and saying, yes, I could deliver you the 4.5%, but you don't fit that scenario. The honest way to do it with integrity, and what I would do with my own mom and dad, is say, look, I can give you a general number of where I think you're going to fall out. I'm assuming an excellent credit score of over 740. I'm assuming from me pulling your property profile and looking at the comps and then looking at the loan amount you have, you're at 60% loan to value, and we can get that confirmed. I know you occupy the house, and I know it's a single family residence, and so I can judge that pretty quick. But if some guy is calling me off the street, there are so many moving parts, and if he's just rate shopping, it's really hard, because I want to keep his interest. I want him to come with me. It's how I feed my family. But I don't want to lie. I don't want to cheat him out of something. And I think for me, I can give general numbers pretty quick based on a scenario you build for me over the telephone. And I could be fairly accurate. But if your credit score, if you tell me your credit, I get people that tell me their credit score is 900. Well, they don't make a 900. So the truth is it comes in at a 620 when they thought it was going to be at least 700. So there's surprises that occur along the way. Find a loan officer that you trust and like. You could ask them to run our pricing engine for you and show you the math. We use Optimal Blue. I think the industry uses Optimal Blue. We put in all those parameters. The computer algorithm runs the pricing scenarios with all the different hits, so we can identify exactly where the hits are at. And then I can quote a loan at par, which simply means 6% plus 0 points, or I can quote a loan at 5.5% plus 1 point. And that 1 point is a fee that a consumer or a seller or a interested party would pay to buy the rate down at the end of the day. Is that helpful? Another big, complex.
We have somebody saying she's a little new to this. So what are points and how do they work?
Okay, good question. So in pricing, there are three, write this down, there are three components. There's your interest rate, there's points, which are also called discount points, which are also called buy down points. And there are non-recurring closing costs, which are the third party costs to close a transaction. So most of the time we try to quote, consumers don't want extra costs. So most of the consumers want a rate. What's my rate? So we quote 0 discount points on most rates. So we will say the rate is 6% plus no points or no discount points, because you're not discounting the interest rate, or no buy down points because I'm not buying the rate down. But if the consumer said, I would like to buy my rate down to the lowest level achievable for my scenario and my risk parameter, then I could quote him 5.5% plus 1 point. And that 1 point is his discount fee to discount the interest rate from 6 to 5.5. Does that make sense? And that point, or 1 percentage point, is of the loan amount. So if it was a $500,000 loan, the customer would chip in $5,000 extra dollars to buy the interest rate from 6 to 5.5. Now you still have non-recurring closing costs. So that's your third component. That's your title, your escrow, your appraisal, your underwriting, your processing, your wiring fees, your tax transfer fees, your recording fees. If it's a refinance, it's your SB2 state of California refinance fee of $225 extra. And all those fees add up to be costs associated with the loan also. Is that helpful? And email me and I can send you, I've got a little flyer on it and it explains it pretty easy. And it's helpful for the customer to know these things too, because that cash to close versus your down payment, they're two different animals. And so most of the consumers say, yeah, I've got 50 grand for my down payment. And what they don't realize, it's going to cost them another 10 or 12 grand on top of that to actually close on the transaction. Okay, it costs banks money to get money, so client is paying the bank's cost of money in addition to profit. Marla, is that a question or a statement? Yeah, fair enough statement. Okay. Yep, banks are in it to make a profit, so they're borrowing at less than what they're charging you and I as consumers. I'm a big proponent also, going back to points, discount points, I'm a big proponent of them, and I'll tell you why. First of all, you can write them off on your taxes, so it's not costing you a full point at the end of the transaction after your taxes. But if you believe that you're going to be in that loan for an extended period of time, then paying points up front can be a cheaper solution for you over the entire length of the transaction. So buying the interest rate from 6% down to 5% may cost you 2 points, but if you're going to keep that loan for the life of the loan, there will be a break-even point somewhere out in 6, 7, 8, 9 years, maybe 10 years, depending on the transaction and what you choose. But then all of a sudden, you're in a better position after that break-even period burns off. And then for the life of the loan, you're at an advantage. The problem has been that we have seen in the last 40 years, interest rates have just continued to decline. So we are now seeing them go back up in this particular time of our life. So if you didn't think you were going to ever see a 5% rate again for the next 30 years, then buying rates, I mean, that's a gamble or a bet that you would take, but it can prove to be the better decision at the end of the day. We just don't know. Someone's asking about the 3 components of the loan pricing today. You have your interest rate, you have discount points, and you have non-recurring closing costs. Those are the 3 components of loan pricing. So most of the time in today's market, if I quote a 6% rate, it's at 0 discount points. But if you wanted to pay 1 discount point, you could buy your interest rate down to 5.5. And then non-recurring closing costs will be on any purchase transaction, rate and term refinance transaction, and or cash out transaction. Okay, what's next? We got a little sidetracked. I'll jump into underwriting just because I think it's important for realtors to understand what underwriting is, and it's really from a consumer standpoint, it's necessary to also understand what underwriting is and think of it as the rules of the game or the guidelines. And if I meet all of the guidelines, then the lender will give me the money. So I have to meet his guidelines and play by his rules, which are non-negotiable, or I don't get the loan at the end of the day. So I thought I would just take a moment and let you know Fannie Mae's guidelines is 1,241 pages of guidelines, and I'm going to do something fun for us real quick. I'm going to see if I can find it real quick. Did it pull up? Let's see if it'll pull up. There it is. Okay, so this is kind of fun because this gives you like, you can touch and feel and point. I got 1,241 pages of single family Fannie Mae guidelines, and I have to meet all of these guidelines to get a loan with Fannie and Freddie. And that's why Fannie and Freddie have gone to an automated underwriting engine. So what that means to you and me is that we put in the customer's unique data into the computer, and we run a desktop underwriting scenario, and the computer has been programmed with algorithms and checks and balances all the way through, and it will approve or deny the loan. And if it's approved, we will get what's called a conditional approval. And I will call that out to you, and I will say, congratulations to you and your home buyer. You are conditionally approved. Now, I'm making a point here to use the word conditional because it's important. A conditional approval is a loan approval, and the loan will close provided we meet all of the conditions. So in most cases, 9 out of 10 times, we can meet those conditions. And a condition might be as simple as missing page 3 of a bank statement. So I just go get page 3, plug it in, and that condition has been met. But if the condition cannot be met, it's a deal killer. So I can still have a conditional loan approval for you and congratulate you and give you a pat on the back. But at the end of the day, I can't deliver you the loan because you can't meet the condition. Does that make sense? So these guidelines on a Fannie and Freddie loan, I think the Freddie Mac loan is actually has its seller servicer guide attached to it. This one's 2,000 pages, but it has the servicer guide attached to it, where Fannie Mae separates them. But they're the same types of guidelines at the end of the day. And if we meet those guidelines, then we get the loan. The jumbo lenders, your Chase, Bank of America, Citi, there's some private ones like Redwood that we have, and PNC, and there's a bunch of them. Those guidelines are nowhere near this. They're 200 pages or less. They're much easier to read and cut through. They're a little more cut and dry. They, however, the jumbo lenders are moving towards using Fannie Mae's and Freddie Mac's guidelines with fewer overlays than ever before. In fact, they have rolled out a true jumbo loan underwritten on Fannie Mae and Freddie Mac's guidelines. So that's a change in the marketplace, and we welcome it. It's about time. And it's a really trick product because we run desktop underwriting. It gives us a conditional approval, and a lot of times it's nowhere near as owner userous as the old school jumbo loans used to want us to document the loan. In this case, we might only need 2 years of W-2s and 30 days of pay stubs to get an approval on $1.5 million loan. So that's pretty cool. Then there are non-QM lenders out there. I explained this in yesterday's class. You have 3 silos of loans. You have Fannie, Freddie, and jumbo, what I call tax return loans. So if your tax returns show that you're generating enough income to support the loan, you'll get the loan, but the tax returns are required. If your tax returns do not support the loan for any given reason, then we move to silo number 2. That's called the non-QM loans. Non-QM still has to verify that the customer's ability to repay is there. By law, we have to show ability to repay, but the ways to get there are different. We don't require tax returns on the non-QM loans. Instead, we will take 12 months of bank statements or 24 months of bank statements that will show deposits, and they will classify deposits as income. Another way they will do it is an asset depletion. So if you had $2 million in a bank account sitting somewhere, you could point to that $2 million and say, well, if I divided it by 120 months, I can give you X amount in income to pay your mortgage. And so you have the ability to repay, therefore I'll approve you. There is the investor DSCR loan that we talked about, and that's just simply using the projected rents on the property to pay the PITI, the principal and interest, taxes and insurance. So that's another ability to repay just from the rents. And then we also have foreign national loans, and those loans are, I call Wall Street loans. They're Wall Street investor money, and those underwriting guidelines are super simple. All of them are under 75 pages. And then the last loan that I thought that we explained yesterday is if you don't fit bucket number 1 or bucket number 2, you still have an alternative loan available to you. All consumers have it across the United States. It's called a community loan. It is backed by the United States Treasury Department. It's not a Fannie Mae or Freddie Mac or Ginnie Mae or FHA or VA loan. It's actually a community loan devised for consumers who do not fit the first 2 buckets. And there's literally 24 pages of underwriting guidelines, and it's so simple, it'll make your head spin. I'll make you the underwriter right now. It requires 2 things to underwrite that loan, all the way to $3 million. You need a 680 FICO score, and you need 20% down payment. With those 2 things, anyone can get a loan. So that's the backup to the backup to the backup. I do them successfully. They are not permanent loans. They are 30-year loans. They are fixed for 30 years. They can be permanent, but if a customer needs to get into a loan and cannot qualify on the first 2 buckets, that is a solution that is available to everyone. Okay, questions?
There are a couple here in Q&A, and we're coming up to 2 o'clock. So if there's,
okay,
they take a look, we probably go over about maybe a few more minutes.
Okay.
So if someone buys a house for all cash, example, $1 million, and later they decide to refinance to take some cash out, how will it work?
Okay, so you buy a house for $1 million, you pay cash for $1 million, then you want cash out thereafter. If you wait 6 months, you can do a cash out refinance, just like nothing ever happened. If you need the money sooner, then it can also be done under a different loan program, I believe. And I don't believe there's, I'll get more of the details for you on it. In the old days, we called it a technical refinance because technically you could have bought the house for all cash, but you needed, or I'm sorry, you technically could have bought the house with a loan, but you chose to pay all cash to win the house, and now you want a portion of your cash back. But I can send you something on that. That's super simple, and yes, the answer is yes, we can do that. What about portfolio loan programs offered by lenders? Okay, so a portfolio loan is a loan offered by credit unions or specific lenders that will keep that loan in their company's portfolio and not sell it off. Portfolio loans, there is a smaller market for them, but they are there. Chase all the jumbo loans are generally portfolioed at least for a period of time, and then they may be spun off to investors. All of your conforming loans, and I don't mean really all because I don't know the true math, but I would say almost all would be sold back to Fannie Mae and Freddie Mac as the ultimate investor. So do we have in-house here at NAF portfolio loans? The answer is no. We have investors for everything, with the exception of one program, which I'll just give you a shout out. We have a buyer acceptance program. And what that means is that New American Funding will use our cash as a substitute for your buyer to buy the house all cash, to win the house, to win the transaction, all cash close 10 days. And then we will sell the house to the buyer right after that 10-day window, right after we close. So that is a proprietary product. It's a portfolio product. It is in-house, and it is a very aggressive program. It's mind-blowing what our owners are willing to do. We're a privately owned company, and it's a program that our owners are funding on the side. We've done over 1,200 of them. Not one is defaulted, and every time it's worked. So I can send you information on that. Do they still offer bank statement loans? Yeah. So a bank statement loan is using the customer's 12 months or 24 months of bank statements to show deposits to verify the income. And so, yes, that's a super common loan. There's even a 3-month bank statement loan, but you have to add a CPA signed profit and loss statement. So if you can get that, then they even have 3-month bank statement loans. Does it change the interest rate? Okay, that's an excellent question. So let's talk about that. It's really important that I believe it's important for you to be able to communicate to your buyers the pricing on all 3 of the silos that are available to consumers today. So your pricing or your cost of a loan in silo number 1, which is Fannie Mae, Freddie Mac, jumbo loans, tax return loans. Okay. So if you're giving me your tax returns, I am certainly pretty confident I know what your income is, at least what you're reporting to the IRS. And if I'm making a decision on lending you money, that's a pretty low risk loan. Therefore, silo number 1 with tax returns will be the most aggressively priced loans in the marketplace today. But if you can't show me your tax returns, then I'm taking risk in not seeing those tax returns. Therefore, if I'm only getting 24 months of bank statements, my interest rate should be higher. So yes, there is a tag to the interest rate when I move out of silo number 1 and into silo number 2's non-QM loans. But is it significant? Honestly, no, it's more. But does it allow the buyer to still buy the house? Yes. Does it allow the buyer to get in under circumstances that he would normally not be able to get in? Yes. So the non-QM loans will cost the consumer a higher interest rate, but it is nowhere near the cost of hard money, private money lending. It's not 12.99% interest rate and 5 points to get the loan, but it's going to be a full percentage to a percentage and a half higher plus points, but it gets you into the home. And then the community loan, the third loan that's available to consumers through the United States Treasury Department, pretty much is equal to the non-QM loans to a tad higher. So today, could I say you're going to be at about 7.75% on a community loan? Yes, but you're only giving me a credit score of 680 and you're only chipping in 20% down payment. That's all I'm seeing. So to adjust for that risk, that higher risk, yeah, your rate should be higher. But is it prohibitively higher? I don't think so. I think it's justifiable. And the consumer just needs to get in to buy the house, close on the house. And if he has his tax returns fixed in a year, he can refinance right out of it. But remember this one thing. Self-employed people that don't have tax returns are heavy cash consumers. They pay in cash, they collect cash, they have huge stockpiles of cash. They are not paying their taxes or their fair or their true share that they may be obligated to pay. So if their interest rate is higher, so what? It's a trade-off. Play the game with your taxes and your W-2s and get a nice conforming loan or jumbo loan with your tax returns, or don't play the game and get one of these other loans, which will get you into the home ownership. It's cheap. These loans are cheap considering how much you've saved on the taxes at the end of the day. So perspective is everything. And I love these loans. I do these loans for self-employed people all day long and they don't balk at all. It's just not a problem. Once they understand what they're saving on their taxes, these loans are relatively cheap. Thank you all. Have a great day.